Hello, and thank you for listening to our presentation today. My name is Amir Armstrong of Group 4, and this is an analysis of the case titled A New Angel's Investment Decision. What does she consider? Seth Schreiner and I will be presenting on behalf of our group members, James Millian and Nicholas Pinto.
The case centers around a woman named Anne, who is a tenured business school professor who is taught and researched entrepreneurship. Anne is a new angel investor. Angel investors are accredited investors who meet minimum net worth criteria set by the Securities and Exchange Commission. Angels typically invest amounts ranging from $5,000 to $500,000 and often look for investments close to their geographic region. Anne is a new member of the Keiretsu Forum, an angel network of over 2,500 members spread across the United States, Europe, and Asia. The privately held new company being discussed is called ZSX Medical and is led by Dan Mazzucco, PhD, and the company founder and CEO, who has 15 years of experience in the medical device industry, and co-founder Eric Ruger, a CEO of a medical device company and experienced entrepreneur and angel investor. The product being the centerpiece of the company is the Zip Stitch Clip, a simple and fast method of internal surgical closure. The preclinical stage medical device Zip Stitch clicks as a breakthrough platform of surgical closure products designed specifically for use in closing internal surgical incisions. Anne must now look at several key factors of the company that are enticing to angel investors because they indicate future success and return on investment. Some of the key factors in this case Anne considered were the potential of the device in a growing lucrative market, the exit strategy, and the strategy of this company to be bought out by a larger firm within 3 years, a pre-money valuation of CSX, which is at $7.5 million before funding and investments. CSX Medical is selling participating preferred stock with preferences of 20% warrant coverage, meaning those specific priority stockholders have a right to an insurance of 20% additional shares at a determined exercise price. There is a liquidity preference of 1x, so the person who puts in the capital will have a preferred level of financial protection. And the terms also included priority to investors for distributions, anti-dilution protection, and preemptive rights, and future co-investment rights. But the point of this case is the one factor that angel investors like Anne hold dear: leadership. The most important question to ask is, does the company in question have experienced and capable leadership? Anne and fellow angel investor John have decided yes. Dr. Mazzucco earned a doctorate in medical and mechanical engineering from Harvard Medical School and the Massachusetts Institute of Technology. Eric Ruckert, again, is a successful angel investor and has earned a degree from UPenn and has had success in similar businesses. The only hesitation in this process is of getting FDA approval, which could be lengthy and expensive, but is something Dr. Mazzucco has successfully done before. Ultimately, Anne decided to invest in ZSX Medical, estimating that at least doubling her investment in 3 years. As stated, Anne sounds as if she has already made up her mind already, even if she takes the time to sort it out in her head and double-check all of the reports. She even goes so far as to ask for a second input from her friend John. The problem here is that everything, including her friend John, says that everything is great on paper. Not one shred of what if really comes across from any source. Since nothing is perfect, even if it does look great, aside from the anxiety of investing a large sum of money, what does she actually question about the whole venture? Because if it is all 100% perfect, why is she even questioning it in the first place? There must be some doubt somewhere for her. While it clearly seems that Anne has made up her mind already, even before asking her friend John, doubt seems to be creeping in. The question is why? What doubts could she have? For one thing, $50,000 is a lot of money for most people, especially one for a new business of being an angel investor. Even if the company doesn't fail, who's to say that she will see her investment return, and with a profit in such a short period of time? What if the project isn't a smash success and it takes more than 7 years to see her initial investment returned? And what if it doesn't come with a profit at all? Could she have used that money elsewhere on a more successful venture? Option 1 is to go with her gut feeling and make a decently sized contribution, but not one that's big enough that she couldn't recover if she loses it all. This would be the safe route. She wants to test the water of an industry that she isn't all that familiar with, but has high hopes for. A successful venture here might lead to a bigger success down the road. Option 2 is certainly the risky route, but has the biggest potential for a massive payday. While a more experienced individual might choose to contribute a larger amount than $50,000, knowing that $100,000 or more would have a much larger return. However, sometimes the risk isn't worth the reward. The last option is to simply not invest at all, for fear that this seems too good to be true. As stated earlier, nothing is guaranteed, so having something that appears to have no apparent downside could be considered a risk in and of itself. Sometimes you can get so excited about an investment that you overlook the flaws, and by the time you realize this, you are in too deep and unable to leave without substantial loss.
After carefully reviewing the recommendations, we believe that recommendation 1 would best suit Anne. Based upon her experience with Keiretsu Forum, Anne felt confident that ZSX Medical had been carefully screened prior to the presentation. She also knew that the due diligence report would provide sufficient detail on the investment for her to make an informed decision. The 4 aspects appealed to her the most were the exit strategy, which was acquisition by a large healthcare company. The second was the capital raise because the company's success in raising money and pre-money valuation. The third was financial position that looked very strong due to the upward trend in revenue. And lastly, the management team, which comprised of Dr. Mizuko and Eric Regard, both of whom were experienced entrepreneurs and had successfully raised capital. Dr. Mizuku, the company founder and CEO, has over 15 years of experience in the medical device industry. An angel investor typically bets on the jockey and not the horse. Although one can make the argument that she should invest more due to her thorough research and positive potential of the company based off of the case study, Anne was still also a new member of the Keiretsu Forum. She did not want to invest a large amount of her portfolio in a single early stage company. Anne's goal was to diversify her investments across 10 early stage companies. Anne consulted with John, who was a member of Keiretsu Forum and was on the due diligence team. John had a reputation as a successful angel and made a point that some of the companies operating in growing industries with attractive target markets did not generate a positive return sometimes. In fact, some even failed, to his surprise. He also shared that he invested in companies operating in stable industries with questionable technology, but the companies ended up doing well after all. In the 6 months she had been a member of Keiretsu Forum, she had already made 2 investments in Keiretsu Forum companies. Understanding that early stage companies have potential to generate high return, she also knew that early stage companies face many risks. If she does not invest, she will be missing out on potentially a great opportunity. From there, you can weigh out the possibilities of a good or bad outcome. Anne would find her happy medium with her initial investment of $50,000. This way, she doesn't run the risk of losing it all and also not pass up an opportunity. If you are hesitant on taking a risk but everything appears to check out through your research, I would say make the investment but still leave a cushion for yourself. The implementation plan would just be for her to simply invest the $50,000. When Anne decides to invest her initial amount, she has already calculated her return of investment. Investing $50,000, she calculated that if the company exited in 5 years at a 2 times return, her return of investment would be $100,000. A 3 times return would generate a return of $150,000. She also can invest in other early stage companies as planned to diversify her portfolio, which is in line with her goals. I hope that you enjoyed our presentation. Thank you for listening.